Sean, thanks very much for taking out the time and speaking with us here on BloombergQuint. The globe is, the equity markets are at unrest. Every other asset class seems to be a bit more turbulent. What kind of move are you expecting to see in terms of whether or not this risk-off mode will continue for a much longer time now?
I think, good morning. I mean, why is it happening? Why have we got this risk-off going on? It's clearly because we're seeing the virus spread into the US quite rapidly. But if you look at what's happened in China and Korea and other markets where the virus has happened, that's been the normal pattern. You get very quick multiplication of it. I think that's what's happening with the markets now and the impacts on the economy. We have had, in the last 3 to 4 weeks, one of the biggest corrections in global equities and credit and high yield since 2007, and lots of flows out. So we've had the big severe correction, and we now just had a week of whipsawing. It's news on the virus relative to policy response. And obviously policy response, will help the economy in the medium term, but it won't help control the virus. And so the market is oscillating between the two. So at the moment, we would suggest be cautious, but be prepared to be adding to the risky areas, because we do think this would be temporary. It will peak in a month or 6 weeks, and we'll look back and think, actually, that was a very, very good buying opportunity.
Sure. So this seems to be the quickest, the pace of the correction has been the quickest in history for the equity markets. But Sean, while obviously there's a coordinated effort by a lot of central banks to make sure that there's ample liquidity in the system and that doesn't suffer, the lingering effect post-coronavirus is something everyone's been worried about because, a 50 basis point cut, what can it do in an environment which is facing a severe supply and demand shock?
Yeah, I mean, 50 basis points cut, it was called an insurance cut. It's not going to do anything in the short term except help the asset prices go up 1 or 2 days. And actually, the day that the Fed cut, the market went down. It was only when Biden, was doing well on Super Tuesday that the market then went back up again. I think the issue is that we had a big fall in Asia at the beginning of the year, or from the 23rd of January, when the market started to factor in the coronavirus in China. And emerging markets came under pressure on that. So most emerging market currencies came under pressure, India included. And the developed markets carried on going up through that period. So, by mid-Feb, we got to a situation where people were saying, well, we've got 0 or negative GDP in China this quarter. But the US stocks carried on like nothing was happening. And there was a very, very narrow, the people in the US were very narrowly invested in a number of tech stocks. And, I think that has also helped exaggerate. People went into the markets quite long of equities. And, positioning has been changing very quickly. And I think that's why. But the biggest enemy is the fear. I'm sort of less worried about the impacts of the virus on, in the health-wise, because the more you see the cases coming out, the more you see it seems it's like around 5% of people who get the virus are not going to be that well and need, hospitals, and sadly some people pass away on it. But it's quite in line with the patterns of normal flu. But it's the fear that people haven't dealt with it in the past. And so, when you see these numbers coming in New York and areas, people panic, and that panic alone stops the consumer. Right. And, that's really the lesson that we can read for the developed world from Asia.
Mm-hmm. Sean, the irony of it all is, the country from where this started, China, seems to have come back to pre-coronavirus levels while the rest of the globe suffers right now. We've seen fund allocations also taking a little bit of a backseat right now. Do you feel that big money coming into emerging markets is going to be some time away now?
Yeah, I mean, the flows out of emerging markets have been quite bad. I do think that, the virus, sadly, is going to lower people's GDP forecasts for this year. And, it's hard to be buying emerging markets in that environment. However, if you look through a year and you assume that it's temporary, and then we get a massive pickup in economic growth from V-shape, then I think emerging markets look quite attractive. China's held up pretty well in the A share, partly because it sold off and was under pressure for the last few years because of trade, partly because the government sort of encouraged people not to sell it, and partly because the government has been signalling that it will do anything it can to help the economy, and if the government wants to do it, it can. And then we've seen a lot of evidence of that. I think the market hasn't factored in quite a huge fall in earnings in China, but maybe it's over in the rest of emerging markets. Maybe it's been overly sold off, particularly in some of the commodity areas. But it still depends on what happens to US growth and what happens to the spread of the virus in those areas. Because you could say, well, Brazil, which was a really good structural story with a new president going through a lot of reform, seeing GDP coming from negative to positive, interest rates coming down, a huge debt burden, not paying so much every day because of that, changing the pension fund system. You'd have thought markets like that could be more resilient. But when you start to get the currency coming off because people are saying, well, we don't want a high yield risk, and then also you begin to get a few cases there, people get very nervous and the markets come down. And then I think in Asia, it's all to do with specific sectors. So, one of the biggest themes in Asia has been Chinese tourism and Chinese trade. Now, the trade could probably come back quite quickly because when we were seeing factories back to work about 68% and migration index about 92%. So right. China's getting back to normal, but the tourism won't happen for a while, and that's obviously going to affect domestic markets like Taiwan, Korea, Thailand, and that's going to put pressure on the currencies, on revenues, right. On businesses.
Yeah, that's a pertinent point. Sean, I just heard you in your opening answer say that we will eventually see a swift recovery. The question is, between now and that eventuality happening, what's the quantum of price damage that you see, primarily because of the factor that you spoke about, the fear in the minds of investors?
Yeah, I mean, I say that in terms of the recovery, because if you look at what's been happening in China, that is what happened. You had a few cases that really then multiplied, and then, but 6 weeks into that, we're seeing the cases drop quite dramatically, almost as quickly as they went up in China. Now, the difficulty in other areas is that China contained it. So if you look at 30 provinces in China, they had less than 500 people. So clearly, when the government realized that this virus was serious and they locked down Wuhan and Hubei province, that clearly worked. Now, some could say, well, it was 6 weeks too late, but whatever, it worked when they needed to get it done. And that's now, getting it back to normal. I mean, we're assuming we don't have a second wave in China. Other areas, it's going to be more difficult to tell on the markets because, it depends on what people do. If you look at the sort of Singapore model, Singapore has had like the same sort of cases as Hong Kong, but it hasn't locked down. It hasn't sent everyone back to home. It hasn't closed down schools, but it has, in every area, it has a screen, right. A health screen, a temperature screen. So the economic impact won't be as bad. Hong Kong, not so many cases, but no one's been working. The economic impact will be worse.
That's true. Sean, just very quickly.
So it's a trade-off.
Okay, it's a trade-off, sure. Just one very quick question. How closely do you look at India, if you do?
Yeah, I mean, we run Indian funds, and we invest in India through our Asian and emerging market funds. Yeah.
Or are you bullish, or do you see issues out here? Because India, aside of being correlated to the world as every other large economy is seeing one or two individual issues of its own as well.
Look, I think this is a sort of time where India could really shine because it is less driven by the global cycle and by China. And, with the tech battle going on between the US and China, you could see production move to India. But India's probably not going to shine at the moment in that because GDP growth underperforming. And it underperformed last year, and it seems like it will underperform this year. And I think the fact that Prime Minister cut taxes is very good and maybe good incentive for foreign companies to move. But the Vodafone issue will also put foreigners off. So I think it's got all the potential there, but it really has to deliver. And what we are worried about, and we have less money in India than we have had in previous years, is what's happening to the growth rate. Yes. Because India is clearly underperforming that growth rate that it should have.